Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 132nd VideoCast, 122nd podcast for the week ending April 29th, 2022. A lot to cover this week, so grab your pen and paper because there is going to be more information packed into a shorter period of time than we've done ever before. First off, I want to start with the media. Thanks to Ellie Terrett, Cheryl Cassoni, and Liz Clayman for having me on the Clayman Countdown yesterday. We were talking GDP. Many of you saw that we had a negative GDP print, negative 1.4% first read for Q1. The fear out there is obviously 2 consecutive quarters of negative GDP equals a recession. I don't think we're going to have that just yet. The reality is most of the decline, about 4.5% of that GDP decline, came as a result of shrinking inventories, a record U.S. trade deficit. This was timing of the shipments based on the supply chain backups, and reduced government spending, which was largely attributable to defense spending. Everyone knows that defense spending is going to rise exceptionally over the next few quarters, particularly with Russia, Ukraine, NATO. The trend is going to reverse a multi-year low, both in the U.S. and internationally. That's why we've liked defense as a theme for some time. We continue to like that. The other thing that came out of that report, consumer spending rose at 2.7% after inflation. That was the highest in 3 quarters. And business investment jumped 7.3%. So there was a lot of positive in that GDP report. Better measure is to look at final sales to U.S. consumers. That strips out exports and inventories. And that was over 2.6%. But the point I laid out to Cheryl is that earnings are the name of the game, okay? The generals of the market largely held up. Apple was strong. Microsoft was strong. Google was very strong, actually. Google only missed on YouTube 10% of the estimate, $600 million, because of the Russia-Ukraine war. They lost YouTube revenues in Eastern Europe, is what Ruth Porat said. They're going to buy back 70 billion of stock over the next year. So all in all, they were good. Apple was very strong. Amazon was weak. We'll talk more about Amazon, but Amazon basically was, they missed on revenues, but they've spent more on CapEx in the last 24 months than in the previous decade. So they overspent to catch up to the COVID demand, which really helped out the country. Now they've got to rationalize costs. It's slowing things down. They're getting organized. They're catching their breath. They're digesting it. They bit off more than they could chew. But the e-tailing and the CapEx, that was a headache, and it missed expectations, and guidance was not good. But cloud was still up 37%. That's huge for that business. The ad business was okay. So I wouldn't count Amazon out completely, but lower conviction than some of these that have, Facebook increased their daily active users, the market like that. Today, by the way, if you're wondering, this is a big end of quarter sell-off. There was a lot of turmoil this quarter, in case you haven't noticed, and people just clean their books at the end of the quarter. I think what you're going to find, not at the end of the quarter, at the end of the month, I think what you're going to find is as we get into next week, we're going to see what's what moving forward. And we'll talk about some indicators that we're looking at. But to Cheryl, the name of the game was earnings, over 230. That's up from 225 just 8 weeks ago. And if you remember, we've been talking since the beginning of the year. We thought earnings, as a matter of fact, the end of last year when they were at 219, we said they're going to get to 230 in Q1. Well, we're just 1 month past Q1, and we just hit 230 this week. So we'll talk about that. For all of the kind of fear in the market, sentiment is completely washed out. We'll talk about that. Earnings are still going to grow 10.9% year on year. And if you look at 2021, the S&P peaked at 4,800. You add 10.9% earnings on that, you're looking, we could see a peak in the S&P over 5,000, 5,100, 5,200. That is non-consensus right now, before we have to worry about the real recession, which I think comes next year on a lagged basis. We did invert the curve this quarter, so I would expect a shallow recession in 2023, but I don't think we're going to get one right now. If the facts change, we'll change our mind, but this GDP report, I think, was more noise than signal. The other thing that we have to keep in mind is the Fed may use this noise as an excuse to not go so fast. I do think 50 basis points is hiked in. I do think the market's jittery about that meeting next week. So that may be a lot of what you saw with the sell-off going into the weekend. But we'll get through that meeting. 50 is expected. We'll probably get 50. The question is going to be, do they go 75? And people are worried about that in the following meeting. I think they're going to talk that down, and they can use the GDP number one and the core CPE came in today lower than expected. We've been talking about peak inflation. Yellen said that we may be at peak inflation. Secretary of the Treasury, she used to be Fed chair, as many of you know. We could certainly be at peak inflation based on those CPE numbers today. And we're going to go through a bunch of commodities in this call. 80% beat rate on the bottom line, 70% on the top line. City Economic Surprise Index hit 70, which was its highest read in over a year. Factory activity was up, and sentiment, which we'll talk about, completely washed out. Every time we've got sentiment that low on the AAII in the past 30 years, 6 months later, the S&P is up 12.5%. 12 months later, it's up 20%. That's compliments of Ryan Dietrich over at LPL, hat tip. And so what to buy, she asked me. We still like value tech here. We do think GDP is slowing. There's no question about that. We do think if we're at or near peak inflation, you're going to start to see the rate of change in yields. Yields have not moved in the past couple of weeks, and they even came in a little bit, and then they popped up a little bit today. I think that's some month-end nonsense, and maybe a little bit with the inflation noise. But when you look at Facebook trading at 14 times forward, Intel trading at 12.5, and I know Intel, they keep disappointing. They're like Boeing, but Boeing is a duopoly. They're probably going to have to change management again. The guys, I mean, they're just a clown show over there. But as you saw in earnings, obviously there's supply chain impacts and everything else, but it just seems like mistake after mistake after mistake. They almost need to bring in someone from the military to run the damn thing because they don't seem to know what they're doing. It could just be time, but like, how can you screw up a business that you have no competition? I mean, all they have is Airbus. Airbus is sold out. Like, if they could just stop screwing up, they would have more orders than they would know what to do with. So if this guy doesn't figure out how to stop screwing up, they'll get someone in who does, and the stock will be back up. But we know if you look out 3 to 5 years, this is back over 400 plus. Why? Because, again, it's a duopoly. Is travel demand going up or down? Is the global middle class increasing or decreasing? In the developed world, it's stagnant. In the developing world, it's growing in leaps and bounds, and that's what we're looking at as the aggregate. Taiwan Semi, I like some of these semis. I mean, Taiwan Semi's guidance was a little bit weak, but their earnings were strong, and they're only trading at 14 times forward. The market's trading at 18.6, which is in line now with the 5-year average, so that multiple has come in meaningfully. And Google, 17.6 times. Again, going to grow. Taiwan Semi's, by the way, trading at 14 times, going to grow at 20% a year for the next 5 years. Google's grown at 17% a year. It's trading at 17 times, lower than the market multiple. I mean, really, on a bad investment accounting and on $600 million on YouTube, they picked up short. Still, TikTok is growing like a weed. And by the way, you should check out our TikTok channel. That's growing like a weed too. I think we've picked up 2,000 followers in the last few weeks. I've got this guy, Presley, here in town who listened to our podcast VideoCast, and we met for breakfast, and he's been doing an unbelievable job on the marketing side. Check out @official hedge fund tips on Twitter. He puts out tons of amazing clips. It's a quick way to just keep up to date with everything that's going on. But Instagram Reels is growing. Their views to compete with TikTok, 30 billion views, Instagram Reels in Q1, which is 4 times greater than the previous period. So Mark Zuckerberg is catching up to TikTok. YouTube is figuring out with YouTube Shorts. So TikTok will keep growing like a weed, but these are going to grow as well. And I think people are underestimating because creators are just going to post across all of them. So I wouldn't count value tech out. I don't want those companies that are trading with no earnings that have just been hammered because they're still trading at 10 and 20 times sales. As a matter of fact, unfortunately, we couldn't get it done in time, but Carter, my junior analyst intern, he was putting them together, and he said that in the last 60 days, if you take the top 30 weights of the ARK Innovation ETF, the aggregate earnings power of those top 30 companies was down 40% in the last 60 days. We're not posting that yet because I told him you need to triple and quadruple check that before you post it. But they're down meaningfully, and they didn't have a lot of earnings power to start with, and we want to avoid that in the short term. I think they're going to get a bounce as rates stop going up, and the sentiment is so pessimistic on them. But I don't know what a bottom is for a company trading at 30 or 40 or 50 times sales based on promises in the future. You know, is it a bargain at 13 times sales with no earnings? I don't know the answer to that question, so I just don't play the game. Going back to my friend Tiho said, errors of omission versus commission. Omission is okay. Take a pass, wait for the fat pitch, stay in your lane. Commission is chasing something that's outside of your area of expertise, and then it's on you if it's a strikeout. Okay, so moving right along, we have. Okay, so thanks again to Ellie and Cheryl Cassoni and Liz Clayman. Moving right along, we were on Yahoo Finance on Monday. Want to thank Taylor Clothier and Dave Briggs, Brad Smith, and Rochelle Akufo for having me on. It was supposed to be all about the stock market. The Twitter deal was announced literally 2 minutes before I got on. The producer's in my ear. She goes, can we switch gears and just talk about Twitter? I'm like, sure, no problem. So we did that, very lively and animated. Great questions from David and Brad on this one. Definitely check that out if you're interested in Elon Musk, Twitter, Tesla, etc. Then I want to thank, this one was funny. This was Michael Tisch and Kinsey Grant over at public.com. It's like a Robinhood. It's an online brokerage. And they have a lot of good guests on. And Kinsey was obviously not a big fan of Elon Musk, and I obviously was. So it was an animated interview, very respectful and fun. Love to talk to her again. Asked some really sharp and pointed questions. But I loved one of the reviewers on this YouTube clip that I put up said, you dropped the mic 5 or 6 times. Congratulations. So like, you know, every kind of arrow that was tossed at Elon Musk and buying Twitter, I kind of laid out some reasons that we thought it made a lot of sense. So definitely check that out, only if you like Elon Musk. But thanks to Kinsey and Michael, because if you don't like Elon, you're not going to like that interview. Also want to thank Ali Thompson and Alicia Nieves over at Cheddar for having me on the show to talk about Microsoft and Google Alphabet's earnings. We kind of just covered the Alphabet's earnings. Microsoft just hit on all cylinders. Their cloud was up, I think 46% Azure, and they're just cooking. So you can watch that. Then I want to thank, this was a busy week. Gosh. All right. Bansari, Kamdar, David Randall, Herb Lash, and Louis Krauskopf. We were talking ahead of earnings. There's a lot of anxiety ahead of earnings because if they don't hold up, there's nothing left to hold up the market. And that's exactly the case. The generals had to come to bat, and they did, believe it or not, despite this short-term, hype craziness about Amazon. Apple was the most important thing. Great. Microsoft, Google, Facebook, huge saves. And I think we're going to start to see the benefits of that sometime next week. Then also Herb Lash for including me as an article on Friday. Market was down last Friday also. Everyone thought it was about something about the Fed. It was actually about the French election with Le Pen. She did not get elected, so Frexit was off the table, and the market kind of relaxed after that. Couple quotes to get us started. This one couldn't be more appropriate from Charlie Munger. The wise ones bet heavily when the world offers them opportunity. They bet big when they have the odds, and the rest of the time, they just don't. It's that simple. And I think what we're coming into right now with China is we've got big odds. We've been talking about it for a lot. We got a huge break overnight. China, they basically said, we're going to support the platform companies. We're going to throw all the stimulus at it. We're going to meet with the U.S. regulators about the listings. We'll go through some of these things in just a minute. And all of them were up pre-market, 12%, 13%. BABA was over $100. I think it closed up 7%, despite the fact the U.S. indices were just puking out. And I think the only reason that they closed up, obviously the news was good. I just don't think there was any shares left to sell. I think all the weak hands have sold out of it. So they couldn't close it down no matter how much they tried. It closed up 7%. Here's from Buffett: no matter how great the talent or efforts, some things just take time. You can't produce a baby in 1 month by making 9 women pregnant. From Warren Buffett. So it might be a little dated of a quote, but it makes the point. And I think we've all experienced that in the last couple of months with BABA. And I think now the tide is turning, and it's turning very, very fast. And we're happy about that. As a matter of fact, I put out a joke about this. Here it is. Okay. This is funny. After consulting with his technical analyst, Xi Jinping, chief market technician, just wanted to make sure he, quote, filled the gap before running the stock up. So if you remember last week or the week before, I said, worst case, we have to go back and fill this gap before it takes off. And we literally filled it to the T. And then a day or two later, he announces all this thing. It traded right back up above 100, closed up in the mid 90s, but we're back off to the races, and it's based on the policy. So who knew Xi Jinping had his CMT designation? That's the CFA for technical analysts. And sure enough, he filled it to the T, and then made the announcements and ran it off. I'm half joking, but all right. So moving right along, where were we? So some of these things just take time. And many of you have been patient, and we're going to get rewarded for that for sure. Individuals who cannot master their emotions are ill-suited to profit from the investment process. Benjamin Graham. Those are the people who aren't on the call that didn't make it through, and they sold us their stock down in the 70s, and we're sad for them, but that's just the way the market goes. Okay, moving on to China news. Censors in China are having a hard time silencing all the rage right now. People have lost their trust in the government. These are some things that were happening ahead of some of these blinks that basically happened overnight. Here's from the guy who runs the K-Web ETF. PBOC stated to advance the healthy development of the platform economy, that means the tech platforms, the rectification work of large platform companies will be steadily promoted. That came from the PBOC this week. That is a big deal. The State Council, which is similar to Biden's cabinet, named 20 policies to promote consumption, noting that consumer spending accounted for nearly 70% of China's GDP in Q1. Many internet companies are consumer-oriented, as nearly 1/3 of China retail sales are online. So this is big news that's happening every single day. China tech stocks rebound as Beijing renews policy support. State Council, PBOC reinforced support vows after market plunge. This was on earlier in the week. Tech shares had fallen, and sure enough, they came out with that. 5% slump. All right, we'll get to more of the current stuff now. Here is an NPR Planet Money podcast about China's tech crackdown, back down, how they've reversed their policy now, and they're starting to ease up on the companies. This was another catalyst earlier in the week. Huya and Douyu began layoffs amid tightening regulations on game live streaming. So they're realizing now the effect of all these crackdowns are causing them to have a lot of people without jobs who are now angry, locked down, without food, and going to revolt. And unless they turn this thing on the dime, Xi Jinping's not going to be in power by the time November comes. And they panicked last night, and I think he will wind up in power, and he'll wind up in power with a booming stock market in 6 months with the amount of things that they're doing quickly to shore up the leaking boat that they, by the way, shot the holes in. China lets banks ease financing to distressed developers. Central bank met with banks, bad debt managers last week. Discussion includes resolving risks of 12 distressed builders. Panic buying in Beijing stores amid lockdown fears. So this just shows earlier in the week what was going on and the pressure on the government. And now we're seeing the results of that. China wants to reopen factories after COVID lockdowns. They are doing that with round-the-clock sleeping. That's a little bit older. Xi is trapped by his own China lockdown policy. That's earlier in the week. Everyone knows that. And I think this is the next dam to break. I think he's going to have to blink. And my sense is it's going to be a day in the next few weeks, I could be wrong, where they're going to simply say, we've got these generic Paxlovid pills produced. Every building you walk into, you're going to get your temperature taken. If you have a temperature taken, you're going to immediately take the pills that they'll probably send everyone pills, billions of pills. They can do that. And everyone will have a pill. If you have a fever, you immediately take the pill and you're put into quarantine, and everyone goes about their life as normal as the rest of the developed world is doing. China's central bank seeks to calm markets with support pledge. Okay, that's earlier in the week. Let's get to some of the stuff from overnight. China's Xi pushing to beat the U.S. in GDP growth despite COVID lockdowns. Topping U.S. economy required to demonstrate superiority of China's one-party system. China leaders tells official, well, they better get to it because they are self-inflicted wounds. This is from 3 days ago. So now they had set the target above. Now they've got to do the policies. And the number one policy that they're going to have to do to make this anywhere near a possibility is stop the zero COVID. And that's coming next. China's top chip maker, SMIC, has 2/3 of Shanghai workers sleeping in factory as lockdown threatens semiconductor supply chain. So they're trying to do everything they can. China's central bank steps in to slow its rapidly weakening currency. That was happening this week as the yuan hits 1-year lows. That was just 2 days ago. The yuan's tumbled by about 3% this month against the dollar. They announced that they would cut the reserve requirement ratio on foreign exchange deposits by 1 full percentage point to 8% effective May 15th. This move serves as a strong policy signal. The PBOC is getting uncomfortable with the rapid depreciation of the currency, Goldman Sachs analyst Maggie Wei said. And on Wednesday, the PBOC set the yuan at 6.55, etc. Moving along, China Xi announces another infrastructure push to boost growth as COVID drags on. Xi Jinping called for an all-out effort to construct infrastructure. Proposed projects range from waterways and railways to facilities for cloud computing. The meeting suggests to us that Chinese policymakers have been increasingly aware of the strong growth headwinds from COVID restrictions and continued property downturn, and thus becoming more determined to ramp up policy easing measures. Analysts expect more debt will be used to fund the new infrastructure projects, reversing government attempts in recent years to rein in heavy resilience on debt for growth. So they've done this. This happens again every few years. We cover this, and it's happening again. Now they're throwing the kitchen sink at it. Once they open the doors, look, they're basically in a Ferrari. The government's now realized the Ferrari is not moving, so they've floored the gas. But what they haven't figured out is the car won't go anywhere until you take your foot off the brake and stop the COVID lockdowns. And that, I think, is what we're going to see sooner rather than later. I think the pressure is building. All these unemployed people from the crackdown, now with the shutdown, no food, they are going to flip out. And when you got 1 billion people, if just, a tenth of them flip out, you're toast. So they've got to move. They're trying to move. It may not be fast enough. The only thing that's going to change it is just open the doors, get those generic Paxlovid pills out that they licensed to 5 of their domestic producers in March. And my guess is they're just waiting for that production to be done because they only got the technology 6 weeks ago. So once they have the pills, they'll probably rock and roll with the whole thing. They should probably use our vaccines too, but leaving that aside, that it is what it is. Okay, so this is more on the Xi headed the top economic policy team meeting, which resulted in a press release promising, quote, all-out efforts to support key areas of the economy, strengthen infrastructure construction, sci-fi facilities, water conservancy projects, transport hubs, information infrastructure, that's the cloud, national strategic reserves, etc., etc., etc. Moving along. This was Xi in a bind over who to blame for Xi's COVID outbreak. Well, they manufacture a lot of things in China. I guess mirrors are not one of them. Moving along. Shanghai uses crowdsourcing to survive COVID-19 lockdown as social support breaks down. So look, these people aren't getting food. They're not getting medicine. People are dying because they can't go to the hospital. This is look, this is the best way that I could explain it, okay? Xi Jinping and the CCP are smoking cigars in the dynamite shed right now. And if they don't put those cigars out and open the doors back up to the economy, they're going to blow the whole damn thing up. So they realize that they need to floor the gas. They haven't figured out yet. They need to take the foot off the brake. And that's the next step. And I think we're going to darn well see it based on the panic amount of stuff that they're doing to try to salvage things in the face of COVID-0 and the unwise decisions they've made to this point. Now, this is how a lockdown Shanghai apartment gets food. Everyone has to become an expert on logistics. So they're all going on social and trying to help each other get food because they can't do it through the lockdown. They're like working as a community. That's all the bad news. Here's some good news from, by the way, this is funny. Here's some good news from Zero Hedge. You don't hear that every day. Anyway, they're good guys over there. I mean, they've always been nice to me anyway. So this is the daily new domestic cases in China for COVID. And as you can see, it peaked at 30,000. It got down to 10,000 yesterday. So it looks like our Omicron peak in January, where just as fast as it accelerates exponentially, it crashes just as quickly. And the vast majority of these are asymptomatic. But this chart is the name of the game. If this chart can go, down to 5,000 or so, I think we're going to see really good things moving forward. This is a guy who, PAG founder Wei Jianshan, he runs the largest private equity fund in China, $50 billion. And he says that, he's very optimistic in the long term. He's saying the market sentiment towards Chinese stocks is at the lowest point in the past 30 years. I also think popular discontent in China is at the highest point in the past 30 years. So this couldn't be a more perfect environment, guys. If you think about, and gals, if you think about the last 100 years, the way fortunes were made, whether it was Joe Kennedy in the 20s, whether it was John Templeton during World War II, whether it was the value guys in the 70s, et cetera, et cetera, et cetera. Whether it was the tech wreck in 2001 to 2003 that we covered last week, whether it was the Great Depression, and now the K-Web China internet crash. All of these 80% crashes, maximum points of pessimism, if you looked out, they were generational buying opportunities. When sentiment gets this bad and unrest gets this bad, like, this is blood in the streets. This is an opportunity, and there's always an inflection when pain gets this acute. Sooner or later, it was a little later than we expected this time, but I think we're there right now. China and U.S. negotiate on-site audit checks as delistings loom. This was last overnight. This was a big deal. Talks on bringing the PCAOB inspection team to China are now ongoing. So they're basically saying, all right, you can look at our books. We need to stay listed in New York. We need to be able to raise capital because capital is fleeing like crazy out of China. On-site inspections are the first step to complying with the U.S. law. So you can read this here at Bloomberg. That was really good news overnight. But less emphasized than the China's Politburo ignites market rally with vows on growth. Unusual midday announcement provides relief for stocks in yuan. Top leaders promise to guarantee supply chains and logistics. Promised to boost stimulus and contain the country's worst COVID outbreak since 2020, issuing a sweeping set of pledges that was light on details but enough to spark steep gains in yuan, in stocks in the yuan. Values by the Communist Politburo to meet growth targets and support the, quote, healthy development of tech platform companies fueled a more than 5% gain on the Hang Seng. At the same time, a renewed commitment to COVID-0 raised doubts about the government's ability to achieve that. This COVID-0 is going to go away, whether it's from the cases rolling over or from the pressure. They got to stop it. They got to take their foot off the brake. They've now done the gas and moving right along. Alibaba JD. Lead rally in China ADRs on Beijing growth vow. The Golden Dragon Index, which is like China tech, jumped 8.2% overnight. China promised to boost growth. And considering the macro environment, was there anything else here? Okay. Okay, yeah. deliver on economic targets, and support healthy growth of internet platform companies. A complete about-face, they blinked. According to the statement following, there's about to speed up implementation of supportive measures, including tax cuts, fee reductions, while sticking to COVID zero policy. I think that last part's going to be taken out soon than we know. China plans reprieve. Oh, this was Wall Street Journal exclusive. China plans reprieve for tech giants, including delaying new rules as economy slows. So all the regulations they put in place, they say, we're going to get rid of those. With Omicron variant battering the China economy, authorities are moving to pause regulatory campaign against the technology sector. This is it, folks. This is what we've been waiting for. Don't be fooled by BABA only being up 7% when the Dow was down 1,000 today. Open up 12%. As soon as these, end of month nonsense headwinds go, this is what we've been waiting for. And then the last piece will be the COVID zero getting wiped out. So regulators are planning to hold off on new rules that limit the time young people spend on mobile apps, et cetera, et cetera, et cetera. So you can read this at the Wall Street Journal. I have it posted on the site. Go to hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice, as always. But also make sure you get your email so you get the daily emails. Be in the know. Every day we post 10 to 30 articles that we're reading, and so I think you're getting the message of what happened overnight. This is big news. Now I want to go into commodities real quick, just to give you an idea, because I think we've been talking about inflections of bonds, etc., and peak inflation. Let's just do a quick review. Generally, with the green line are commercials. Those are the ones you want to follow. They tend to get ahead of trends. And here they've been buyers, just like they were the last time before the big rally. They were buyers. You got a monster rally. A rally in bonds means a compression of yields. They've been massive buyers the last few months. I think we're going to start to see this bottom. Maybe it'll have to base for a while, but the key is the rate of change. Yields stop going up. It's going to change the composition. Back out of cyclicals. Everyone chased after they were up 200-300% in Q1. Now they're cracking. They were all puking out of tech. I think they're going to want to buy tech in a slowing growth environment with yields stopping to go up. Just to put it in perspective with people saying, well, multiples are still going to compress. In 2018, the 10-year yield peaked at 325. We're at 291 right now. Multiples were still expanded. And in January of 2014, yields peaked at 303. Again, we're below both of those levels. Tech was doing fine during both of those periods. So I think there's opportunity here on the value side. Moving right along, we have stock markets poised to rebound as corporate buybacks return. That's from Marko Kolanovic talking about as companies report, now they can go back in the market and buy stock. By the way, that's Google, $70 billion. That's Microsoft. They think they did $20 billion last quarter, dividends and buybacks. That was an increase of... anyways, it was a big increase. All of them have announced big buybacks. I think you're going to see it all across the board from FANG. They can start to do that a few days after reporting, so we should see them step in next week. Last week saw the largest outflows from equity since the start of this year. That means people are panicking out. When everyone's on one side of the boat, we usually want to panic in, take the other side of that trade. And we saw a taste of it yesterday. It couldn't hold with the month end. But look at this from my buddy Tiho Birkin over on Twitter. You should follow him. There are plenty of acts. New loans over the last 3 months have totaled 8 trillion RMB. That's 1 trillion US dollars. That is huge. It takes several months for them to feed in the economy. Plus, they're currently a harsh lockdown. In 6 to 12 months, the economy will be going gangbusters. And he's absolutely right, Tiho. This is loans in China. Look at the amount of loans. This is like enormous. This is the biggest amount since right after the great financial crisis stimulus. I mean, this is huge. And I guess the last time was right during COVID, and they had a monster rally out of that into 2021. Then they put their foot off the gas, and now they jammed it back up. And they had the same thing after the great financial crisis. They let up, market corrected, and they jammed it up, and they got a sustainable rally. So this is huge from Tiho. Thanks for posting that. Okay, let's go sector by sector here just to see what's going on with the general market, because I know a lot of people are probably tuning in after seeing the market down 900 points on the Dow. I can't see the S&P right now. Okay, so this is communication services. We think there's some opportunities here. Amazon, give it a few days and see how it pans out. I don't know if we'll cover that, but the basic thing was the stock hasn't done anything in like a year and a half, actually. But the underlying business has grown. The multiple is high, but it's always been high because they have the CapEx. I think that might be worth looking at. I have better conviction with some of the others we've already talked about, but this is all you need to know about these sectors. And these are top weights in the sectors. These are periods where you want to be a buyer, not a seller. If you do the overlay, you'll see that these levels are near inflection points every single time, whether it was 2011 during the Euro debt crisis, 2015-16 during one of the China problems and the oil problem, during 2018, and now during the COVID pandemic, and now these are your chances of success dramatically increase when everyone's puking out and they're getting these points of max pessimism. So that would be communication services, NASDAQ composite. Energy's just cracking and rolling over, so that's got more downside to go. We've talked about that for weeks. Same with financials. I think that's got more downside to a little more. I mean, I look at some of these like Citibank trading at a discount to book. I might get interested again, but I'm not there yet. Healthcare, Cigna, we had a great run, by the way, and we used a lot of those profits to increase up our BABA, which is now 22.92. We went up to close to 300 basis points on the options, which means we'll now have, I think we went 2,900 or something. I don't have it written down. I was talking to Carter about it today. I didn't write it down. But at the end of the day, once BABA is back above 105, which I think got up to like 102 or 103 this morning already, that'll take our blended, because we'll be in the money, which means we can exercise if we choose. Through December, we control it above 105. I think it's going to be well above 105. That'll take our basis down to the low 120s all in when you consider the stock, because the options now are going to control 150% more than the stock that we controlled at 105. So effectively, our real risk is 23, call it 23%. Our, in my view, the only real risk is the 3%, because the 20% is time. Like buying the business at this price, I don't consider that risk. It's just time arbitrage. The risk is the options have a fuse, but they're at low enough strikes now. I think now about 950. Remember, we bought the originals at 840 something, then we bought some at 1050, and then we topped up. Will be our biggest position ever in history. And a basis anywhere below 150. Now that we're in the low 120s, once we're over 150 and those options are in the money, it's unbelievable considering where we started and how we've stuck with this thing. So any rewards that we get cumulatively as a community, we damn deserve. We've been through hell and back, and it's going to be worth it. So we're excited about that. All right. So industrial sector, not yet. Infotech, that's where we are. Again, it's downward at these levels where it paid. Materials, NASDAQ again down at these levels. I just like everything about value NASDAQ and value tech, and no one's really focused on it yet. So I just wanted to kind of show you some of the things that I look at on that front. Hope that's helpful. Let's look at some of the broad indicators, and it's going to point to the same things. First of all, here's the put call ratio, 10 DMA. When it gets this elevated, you're usually near inflections. These are bottoms. So could it go higher? Yeah, but you got to play probabilities. Here's the 1% EMA, advanced decline ratio in the NASDAQ. This thing is worse than the pandemic, making the same type of bottom, and then it took off. It's trying to bottom here. NASDAQ cumulative volume ratio, same thing. Same thing on the declining issues tricks. Same thing on the NASDAQ Cohen high low. Just places you want to be a buyer versus a seller historically, probabilistically. Anything can happen, but you look down at these levels, just the sentiment is totally washed out, and it just creates opportunities for people like us and people in this audience that like to make money from other people's emotionalism and forced liquidations. This is the National Association of Active Investment Managers. Managers got down to 46% this week, so they're going to have to chase up any strength. They're puking. They're just as scared as the retail traders. This is the PMO buy all I told you. Again, probabilistically, when it gets down to zero, you're better off being a buyer than a seller. Historically, so some of these things like the Dow doesn't look oversold enough for me yet, but the NASDAQ does. So that's in line with our general thesis, and I think that's going to play out nicely in coming weeks. This is the NASDAQ McClellan. Again, these are the points. McClellan summation. All right, so it took a breather here. We'll see how that plays out in coming weeks. So I think those are all the key indicators I wanted to look at. And that's the VIX. Looks like a spike level here too. All right, moving right along. This was on CNBC last week. Squawk Box Asia, and Presley cut this out today, and it's getting a lot of 1,800 views because it's what I was talking about to you on this podcast weeks ago. Every time the Hang Seng has traded at a discount to book, good things happen. And here's what I was talking about. I can't put up the volume here, but you can just go to Twitter. 1998, the Hang Seng traded at a discount to book. 17 months later, it was up 156%. 2008 crisis, 21 months, it was up 110%. 2016 crisis, 23 months later, it was up 82%. In the COVID crisis, 11 months later, it was up 36%. And we traded at a discount to book. I think we're going to be up meaningfully in the next 12 to 24 months. This was the gap fill from our chief market technician what do they call that? Certified market technician, or CMT, or something like that. So there you go. Yellen says inflation may have peaked. We agree. We'll talk about some of the numbers. This is from Ryan Dietrich. For those of you worried about the general market, S&P has corrected 13% this year. Average since probably 14, more than that, probably 14% today. Average since 1980 has corrected every year 14%. Note, 21 years since 1980 have pulled back at least 10%. 12 of those times stocks came back and finished the year higher. In fact, up 17% on average at the end of those 12 times. Bespoke shows margin debt year on year. This reminds me a lot of 2012 period, which is also similar in terms of rates and that type of thing. You had the huge spike of margin debt out of the great financial crisis. Everyone chased out of pandemic. Everyone chased, rolled back over, and then you took off again for another couple of years into 2014. So keep an eye on that. Boeing, we covered. That's just going to take patience. They crap the bed, but they have no competition. Like, you could literally put a ham sandwich to run the business and still sell planes. Apparently, this ham sandwich has no slices of bread because they just can't figure it out. But they will, or they'll be replaced. But it's been devastation after devastation. We actually added some long-dated options from the Cigna profits this week just to take advantage. Like, when you see the quality on sale like that, it's like you got to just, add a little bit because Boeing's not going anywhere, but they're trying to kill it. It's just like Xi Jinping's trying to kill the Chinese economy. Eventually he figured out working 24/7, he couldn't destroy it, so he might as well build it back up. I think they're going to figure out the same thing with Boeing. This is all self-inflicted wounds, but they've worked full-time to destroy the company. They weren't successful, so now it's time to build it up with or without new management. Boeing aims for defense buildup. New chief of the plane makers military unit is tasked with reversing recent program problems as government's defense spending ramps up. In other words, we all know government defense spending around the world is going to go through the roof in coming years, and Boeing's figuring out, we want to get a piece of that action. Let's stop screwing up. That's probably a good place to start. Defense stocks beat global market on expectations of higher spending. Boeing now wants a piece of that pie. Amazon stock sinks. That stinks. Okay, sinks and stinks. This part of its business could help shares fly again. This is from Jack Denton. He usually writes decent stuff about Alibaba. This one, he's talking about the cloud business, which, by the way, grew 37% year on year. We think AliCloud is going to be able to continue to grow at that pace, if not more, because they're 5 years behind. The digitization of the China's economy is 5 years behind the U.S. They're just getting started with unquote, AliCloud. And then the second is their advertising business did fine, even though the retail, they kind of created overcapacity to keep up with COVID, and now they're digesting all the investment that they made. The two core parts of the future, the ad business and the AWS cloud, did quite fine. Did fine. This is interesting. Auto giant Magna crushes earnings, but the stock's down. There aren't enough cars. So they sell parts for the cars to the OEMs. The OEMs can't make cars because they don't have semiconductors. We're taking a hard look at the auto parts business because there are some businesses that COVID created generational buying opportunities that will never exist again, at least not for, another cycle and 30 some odd years. These are once in long time opportunities. Charlie Munger turned. So the last time the auto parts cycle was this bad was 2003. Charlie Munger saw an article in Barron's, by the way. He took $15 million in and bought Tenneco at $2 or $3. Long story short, he turned the $15 million into $80 million, and then he gave the $80 million to Li Lu to invest in Chinese stocks, and Li Lu turned it into $500 million over a decade or something like that. So 2 moves and $500 million from a relatively modest stake. So this sector is setting up similarly, and the question is, how long is it going to take to get the semiconductors? I think it's going to be like oil. It doesn't come and then it comes all at once. And I think the same thing is going to be with the semiconductors. Despite Gensler, who got paid $140 million to do nothing last year. Not Gensler. Anyway, the CEO of Intel, it's been a long week, Gelsinger, got, paid $140 million to talk, and, he'll produce it, he'll turn it around. We like Intel, we like it more on weakness, but, he's got to start delivering, and he did on certain fronts. He's going to do the 5 nodes in 4 years. He's got 1 done, so that's good. But, when you look at airlines, when you look at where oil stocks were in 2020 when we were pounding the table, where banks were, these were once in 30-year opportunities that we took advantage of. After they're up 300%, everyone wanted them. Now they're rolling over. I think that China stocks certainly were that opportunity. We think biotech is certainly that opportunity. I think the weight on biotech lately has been because of the ARK. There's such pessimism over ARK. She owns a bunch of biotech stocks, but the problem is there's a big difference between owning a basket of biotech stocks and a basket of other stocks that make no money. Biotech stocks have never made money, okay, on balance. So you basically buying a bunch of lottery tickets, and if you buy a big enough basket, 30 to 100 lottery, enough of them hit where they go from 0 revenue to 6 billion to 10 billion because one of their drugs hits. And very few people are good enough to pick the perfect drug that's going to get approved. So if you buy a basket, you've got enough buying. But when do you buy the basket of lottery tickets? You buy the basket of lottery tickets when it's depressed, when it's meaningfully depressed, like it is right now when you look at lowest price to sales in a decade, lowest price to books in 1986, lowest price to free cash flow, lowest forward PE, all of those metrics. So you know that you're buying the basket of lottery tickets at the right time. So it's okay that they don't earn money because they've never earned money. So there are asymmetric catalysts to the upside in that basket of lottery tickets. That is not the case buying 30 companies that are losing money generally. There is no catalyst that's going to take Zoom's revenues up 10x in the next 12 months. There is no catalyst that's going to take Teladoc's revenues up 10x in the next 12 months. There is no catalyst that's going to take half of these companies that are non-income generating companies revenues up 10x. So that's why biotech that don't make money are different from stocks trading at 20 times sales that don't make money. because biotechs do have those binary catalysts. And when you have a big enough basket and you buy them at a low enough historic pricing, the same poppage happens, whether it's M&A or drug approvals, but you're just getting that popping off a low base, which is why you get those, like the last tightening cycle when the XBI sold off 50% into the tightening cycle and then rose 140% throughout the tightening cycle from 2016 to 18, just like we saw the 50% sell-off now, a couple more percent in this craziness the last month with some of the innovation stock pressure because they're getting liquidated. But I think you're going to see the same type of thing. The rate fears are over, rates will stabilize, and then you're going to see a broom right back into biotech, and we're going to have a run simultaneously with both biotech and China tech, which are two biggest positions. So anyway, the point of this is start to look here. We are building a material company in a position in a company that was a very big company. That's now a very small company that's going to go back to being a very big company. It's all going to be dependent on when the semis come, because once the manufacturers have cars, they have the business, and they've got a ton of the business, and it's that operating leverage. And if you look at their debt schedule, my initial instinct when that happens is go buy the bonds. The bonds must be trading at 20 or 30 cents. The bonds are trading at over par because they're more than capitalized with cash and credit lines that they can draw from. It exceeds the amount of debt, that first tranche of debt that they have to pay over 2 years out. So when that operating leverage kicks, when the semis come in and the new cars come, some of these companies in the auto parts, these are going to be the next Tennecos of the world. We'll probably have more to say about that, but we usually only talk about large cap stocks because it doesn't matter if 400 people on the call buy a large cap stock. They're not really going to move it. This is a smaller company, but start to look at that sector. There are opportunities there. I'm telling you, that's our next thing after China and biotech. MasterCard's earnings handily beat expectations. Spending on travel is the driver. We've talked about the consumer is still strong, so don't get caught into all this gloom and doom. Especially you saw Google's core business services up 21%. Meta stock is roaring after earnings. Here's what's behind the big move. That's more daily active users. Their Reels business is rocking again. ServiceNow stock is flying as companies keep spending. This is key. This is what's coming up. This is all the basket of kind of SaaS got thrown in with the innovation stocks like CRM, which is generating cash, which is Salesforce, like ServiceNow. Microsoft, we saw the spending was huge. Azure was huge. Cloud was huge. Record-setting numbers. So enterprise spending hasn't changed. Why? Because the only way to bring down cost is to automate processes. The way you automate processes is enterprise spend. So I think a lot of these SaaS stocks that got battered, which is battered the NASDAQ, are going to start to get bid. We're seeing it with ServiceNow results. We saw it with Microsoft results. Let's get through these bumpy few days with the Fed meeting, and I think these things are going to start to get bid in a material way. Europe is stepping up its defense spending. Okay, that we've talked about that. Nokia stock rises as strong 5G demand leads to an earnings beat. We've talked about that stock before. That's a small one for us. U.S. GDP. Okay, we covered the GDP. Heartache on the dance floor, stock market, and sentiment results. By the way, for any of you listening on the podcast, you'll get cut off in 7 minutes. Just go to hedgefundtips.com and you can scroll down here to VideoCast and it will come right up. Fast forward to minute 60. You will pick up word for word exactly where you left off. And if you want to go back and view some of the charts that you missed, definitely go do that. But I love this song by John Party. As a matter of fact, I just booked my wife and I to go see him in September after doing this article. But this is what everyone feels like lately in the stock market. That was at a friend of mine owns the local semi-pro hockey team in the rink in Connecticut, and he put axe throwing in at the bar, and that's exactly what people want to do. This is what it felt like in the last couple of weeks holding equities. You'll see here. This guy gets knocked over the boards into the guest bench. Nothing worse than that. And if that wasn't a vivid enough picture, this is a golfer I've started playing again at the club. And that's what it feels like from time to time. I'm sure I'll be doing that in my first few rounds. So, okay, we went through this. In 2017, John Party released Heartache on the Dance Floor. It peaked at number 3 and 5 on the Billboard Country Airplay and Hot Country Songs charts, respectively. It also reached 47 on the Hot 100. While not a perfect metaphor for the recent stock market climate, it's pretty darn close. So many companies and sectors now trading down at big discounts, but unwilling to bounce yet. Play that song. It's a good song. So while it's a heartache eyeing these undervalued stocks that don't yet want to recover, we need to bear in mind the wisdom of Cody Johnson in his recent hit, Till You Can't. It's almost like he's related to Charlie Munger, because it says, if you got a chance, take it while you got a chance. If you got a dream, chase it, because a dream won't chase you back. And if you listen to this song, it's actually a very touching song. It's like saying, if you have a time to go fishing with your dad, or, rebuild an engine with your granddad, or etc., take it, because there will come a day when the opportunity no longer exists. And I think that day is coming very soon for China tech. I think that opportunity is going to come very soon for biotech, and then some others, just like the opportunity came and went in banks in 2020 and energy in 2020. And now in 2022, after they're all up 200% and 300%, everyone wanted them. And sure enough, they're opening the trap door on them. And they already did on many of the names. So the General's last stand, they stood up to the battle, and they did quite well. That was some notes from the interview with Alicia. You can look at some of the breakdown here. Sentiment washout. This was about the Twitter thing. That was good. These earnings actually went up. Okay, so this is what I was originally supposed to speak to Yahoo about before the Twitter deal announced. We talked about bad news. We had the inversion. The good news is that stock market can and should still make new highs in coming months, predominantly driven by earnings. Now at 230, multiple below the 5-year average as of today. And then we'll probably worry about a shallow recession next year as the tightening catches up with the general economy. But for now, the economic surprise index, highest level in over a year. You're seeing it here. That was just 2 days ago at 70. Factory activity is ramping up, not down. That's a positive sign. And then this is the magic chart with bonds holding the long-term trend line. This is sentiment on bonds. Every time it's gotten this low, you get a bounce. Or you're near a major low into bidding, which we covered on the commercials. This is from macro charts, so really good job there. And what's to buy when the tide changes and yields start going up? Value tech, China tech, biotech, and we've covered that over and over. We also talked about how when people were this overweight commodities, February 2011, within 8 weeks, it completely rolled over, trapdoor opened, etc. This is Tiho's chart on the sentiment. AAII bulls got completely washed out. When it gets down to these levels, 6 months later on average up 12.5%, 12 months later on average 20%. Also from Ryan Dietrich, just shows the bullish sentiment washed out. Here was the 20-minute interview about Elon Musk with Kinsey Grant. Trade to Level says you dropped 5 or 6 mics during that interview. Great job. So if you like Musk, listen to that. You'll have a lot of laughs. And then this was the sentiment today, got down to 16.4. So, it couldn't get any. Sentiment's completely washed out. And these are buy levels, not sell levels. If you're selling in the hole like this, then you're not cut out for this business. That's really what it comes down to. Here's another visual on the AAII bull bear spread. These are buy times you want to be buying. Again, nothing's guaranteed in life, but these are probabilistic, and you gotta place your bets when the odds are in your favor. Fear and greed got down to 29. My guess is it's in the low 20s today. This dropped to 45, so managers will have to chase up, and that's that. So we did that. Here's the data on Yahoo that Dominic Chu is going through this morning. Basically, the stock has done nothing in 1-2 years. Amazon. So you're buying one of the best businesses in the world. You got to back out the capex so you can understand what the cash flow is. It's probably cheap here. I'd give it a few days to settle out because it was kind of like a panicking into the close. But there's probably going to be opportunity here for the long term in coming days. He put a couple other good things here. Oh, this is a good visual. So this is the Amazon's average forward PE. So it's near the bottom end of the range. This probably came down today. I mean, the bare bones bottom is when it gets to about 50 or so over the last 5 years. It has traded as high as 180. when they're doing more investment. They've been doing serious investment in the last 2 years, and the multiple is still low. It gives you an idea of how much cash they're generating. So it's towards that bottom of the range. There might be a little more to go here, but that did a decent job of putting it in perspective. And he also pointed that it went from a $1.9 trillion company at its peak last year to a $1.3 trillion company today, which means it lost a whole Facebook on this rate fear period when many of these stocks have actually sold off, had multiple compression on rate fears, which I think are now nearing a peak. Here's the earnings. We hit the 230.09. For those of you who listen to me on a regular basis, I've been pounding the drum on that number. We finally hit it, and sure enough, just like with Cigna, if you remember, we finally hit the 270 and took some profits there. And we'll take some out for till the end of the year, but we rang the register on that. All right, some economic numbers from the week. Durable goods orders were good. Let's get to... By the way, Chinese industrial profit was up 12.2% year on year, which is pretty interesting. Year to date up 8.5 versus 5 last print. So it's amazing they're pulling this stuff off. And people always say, oh, you can't trust their numbers. Well, what about when their numbers were so horrible? No one said you can't trust their numbers. So, I mean, you got to take that with a grain of salt. Okay, continuing jobless claims did miss expectations by a hair. But core PCE prices were below expectations. They were expected to be as high as 5.4% up. They were only up 5.2%. So that is pretty good. And then the core PCE price index also was less than anticipated. The last print was 5.3. Expected print was 5.3. It came in at 5.2. So this is giving the Fed a lot more leeway with the GDP print and these inflation numbers starting to peak. The comps are going to get tougher and tougher on inflation, which means that starting in May, you're going to see these numbers come down year on year because inflation really accelerated in May of last year. So the year on year is going to look less and less, and you're going to see how inflation's peaked and the rate of change is collapsing. You're also seeing it in trucking rates, etc. So all in all, rig count's up again. Let's see. That's off the pandemic lows, was at 244. This week it was at 698. So that oil's and pre-pandemic it was at 793. So we're getting up there now. 7 of 793. You know, that's getting back to pre-pandemic levels, and that's good to see. And here's the core CPE price index year on year rolling over. This is re-earnings. Carter put out the cumulative earnings power of the top 30 stocks and was revised down by 1.1% in the last 60 days. I think utilities was also in that ballpark. You'll have to check the website for the updated stuff. Hopefully finished ARC and there was one other one. Oil services companies, I think was revised down. The top 30 weights of oil services, he was telling me, was revised down 4% in the last 60 days. GDP Mirage, we talked about that. It basically says the consumer and business investment is still strong. Here's utilities down 1/10 of one basis point in the last 60 days. So flat. These stocks have shot up huge in fear. We have one short in the trade service on that. We think they're going to take a breather. Let's move on to the questions of the week because I've got to get to an opening night golf dinner tonight at the club in 54 minutes. All right. JT Investor, Tom, any updated thoughts on Disney? Traded off hard in sympathy with Netflix and the political headlines. I think we covered this last week. Disney, you want to buy for the long term. It's fine. Just, ignore the short-term noise. Ben, first name only. Is the stock options positioning once again at the point where the stock market should gravitate higher in order to cause the most pain? I think so. We saw that in the 10-day moving average of the put call and the VIX. We're either there or getting close. If you look at implied volatilities, the pricing is very, very high. So they're helping the people out selling insurance when the price is high, and those people are going to get left holding the bag. Tom, what are your thoughts on Google in the short term? I have no thoughts on anything in the short term with the volatility, but long term, I think it's a relatively reasonable multiple. All right, Ben, saw your excellent April 27th Cheddar News interview. Great info on Google. You said Google has 70 billion of buybacks coming. Please explain the timing. It's over the next year at the discretion of the board. They don't tell you their calendar dates so you can front run them. You'll have to ask Morgan Stanley for those dates. And to do so, that's a joke, by the way. They got in trouble for doing that. All right, next. Rob R. Historically, biotech is a screaming buy when companies trade below cash on hand. I calculate cash working capital on balance sheet per share of XBI around $20 for the constituents on a weighted basis. Do you have a different estimate? That implies downside to $20 for XBI. What do you think? I think that's ridiculous. Not that I think the effort is Trojan, but there's never been a time that you could buy a basket of biotech stocks where the basket was trading at a discount to cash. That would imply that we were in a nuclear war, Great Depression, that you could just buy, 30 companies in aggregate at a discount to cash. What's happening right now is there are more companies than normal trading at a discount to the cash on their balance sheets, and the multiples going back to 86 are at their lowest levels. When you look at price to operating cash flow, they have to appreciate 155% just to get back to average. They always overshoot on the upside. Price to forward PE would have to appreciate 111% just to get back to average. Price to book, it'd have to appreciate 24% just to get back to average. Lowest price to sales in a decade. So those are the things you want to look at. This has never happened. It never will unless we're in a nuclear or chemical war and we're in a Great Depression and a zombie apocalypse. And if you're betting on that, you're in the wrong business, because even if that happens, if you bet on the end of the world, it's always a losing bet, because even if you're right, you can't get paid. So, but good effort doing the research. The premise, though, what you should have looked for, was there ever any time in history where the whole basket was trading at a discount to cash? And the answer is no. That just wouldn't make logical sense, because there would effectively says there's no bid for anything. And if there's no bid for anything, it means there's been huge capital destruction, and that means there's probably 50% of the population out of work. So good thought process, but always try to anchor it in reality and look back to see, have there ever been any instances where this would be practical to measure it against for today? What were the most extreme instances in history? What did the multiples look like then? And now what do they look like? And we've covered that over and over. And what we're saying is they're cheap relative to historic extremes in that sector. That's why we're involved, and it's among our biggest positions. Top two. Prasad M. Hi, Tom. Love the interview with Kinsey Grant. Question: if Tesla were to drop significantly, at what price would you buy Tesla? Or did that train leave the station for you a long time ago? I'm trying to gauge whether you think there's another 4 to 5 bagger from here on Tesla in a 5-year time frame. That's a really hard question. I would say the train's probably left the station for me. I wouldn't be surprised if there was another 2 or 3 bagger in, because I do kind of believe him when he talks about the robo-taxis and the humanoid robot business, which could both be bigger than the car business, and the car business will grow, but he's going to get more competition. So, I mean, it's maybe a double from here. It would probably have to drop 50% for me to even start to look at it. That's been my flaw since day one, but I know what my discipline is. I know what my knitting is. This is not my world. I don't guess the future. This is betting on a 1 in 100, a guy that comes around 1 every 100 years. Those who figured that out early got rewarded, similar to Bezos. But, there were 3 guys out of billions in the last 100 years that could do what Steve Jobs did, what Jeff Bezos did, and what Elon Musk did. And picking those was really hard to do. So 999 out of 1,000 times you're going to be wrong on that. It would have to get a whole lot cheaper. And if it does get a whole lot cheaper, it means there's severe problems, which means the growth outlooks are different. But yeah, if it pulled like a 2001, 2002, 2003 Amazon, where Amazon was down 90%, but the business fundamentals were still growing, it was just multiple contraction. Yeah, I'd be totally open-minded if I could buy it on the cheap. I just don't think that day's coming anytime soon. Another one from Ben. I know you like Facebook and Google. I'm not in love with those. These are not any high conviction stuff, but it's like, you know what my high conviction stuff is. What about Amazon? I think wait a few days, see how it settles out. We covered enough on that. Damien says, hello, what are your terms for your incentive fees? Well, I mean, I'll tell you, it's not, private information. We don't charge management fees. We only deal with accredited investors, minimum 5 million. It's 0% management fee, 25% performance fee above 5, 20% performance fee above 10. That's not a solicitation. It's not it's not something for most people, but it's only available to accredited investors and qualified institutions through the PPM. But you asked the question, I answered it. And the basis behind that, we just modeled it after Warren Buffett. We don't feel that we should get paid for watching people's money. We feel we should get paid when they get paid first, which means sometimes we work for free for extended periods, and then the equity curve, explodes. We get paid, they get paid first, and then we have to earn back our pay before we get paid again. And clients seem to like that. It's a fair trade. We only get paid when they get paid first. So with that said, I do want to thank everyone for tuning in this week. We did go through quite a lot of information in a short period of time. Hope you found it helpful as ever. We got a lot of great feedback on the VideoCast podcast last week about the Chandler brothers. I thought that was amazing. Thanks to Tiho for turning me on to that story. And we'll do more stuff like that in the future. So we'll be back next week, same time, same place. Thanks for tuning in. In the meantime, make it a great one. Bye for now.